Welcome to Executive Masterclass Tutorial Center. Our center is located at Shomana Estate, A-Line. We have our YouTube, we have our social media channels that you can follow us to get all our videos that we'll be creating. So you can check on YouTube, Executive Masterclass Tutorials. You can also follow us on our Instagram page, executive_masterclass. You can also check on our TikTok, executive_masterclass. And our Telegram page also is Executive Masterclass Tutorial Center. You can also send a mail to us if that you want to be enrolled on our various courses or our various tuition that we are providing. You can send us mail on our executivemasterclass1@gmail.com. So any info that you want about how our courses is being, let's say, registered, or how that you can be enrolled on our based on our tuition, you can send us mail. Or you can also call this number or text +233 245 721145. So when you call this number or text on this number too, you can get any information from us. So today we're going to start with our new part 2 of the consolidated financial statement that we started yesterday. So today our video is going to basically based on our part 2, and which one will be on the basic principles of what? Consolidation. And that one is the basic workings, the 5 basic workings that you should know if that you want to be good when it comes to consolidation. Therefore, the 5 basic workings should be something that should be on your fingertips so that you can find your way out anytime there's any consolidation question. So today, our video that we did yesterday, the part 1 of the consolidated financial statement, it has been posted on all our social media platforms that I just mentioned to you. So you can go in there and can go and get the full content of the part 1, so that when you are watching the part 2, you won't be stranded for that. So today we're going to continue with the part 2 of the consolidated financial statement, and our part 2 is going to be based on the 5 basic principles. 5 basic principles of working. So 5 basic These 5 basic workings are workings that you should know if that you are preparing for your consolidated financial statement for any exam, whether you are at tertiary that you are doing accounting, that is specifically for corporate reporting students, or if that you are doing ICA or ACCA, you should be able to know these 5 basic workings, and that one is what is going to help you to get to know more things about when it comes to consolidation. So without wasting much time, I will start with the first basic workings, and the first one is our group structure. So based on what that we discussed yesterday, we got to know who is a parent, who is a subsidiary, and what makes somebody to become a company to become as let's say parent. So, and the controls that they have, because if they have control and the power, that's when you can consolidate that of the other subsidiary, so their financial statement. So today we are going to continue with the part 2, and that one is the first basic workings we are going to do is the group structure. So under the group structure, there is a lot of stuff that we need to know. You need to know the percentage of shares that the parent is having or has acquired in the subsidiary, so that it will help you to let's say put down your group structure. So I have a very, very simplified note here that I'm going to based on this to help to make you understand what it's meant by group structure and some things that you should know if that you are let's say putting down your group structure. So I have a question here that I will read it, and I will deduce some of the important stuff of it so that we can base on it to do our group structure. So the question here says that on 31st December 2008, Bernard acquired 4 million of $5 million $1 ordinary shares of Benjamin. So Bernard acquired 4 million shares of 5 million shares of Benjamin. So based on this, you should be able to know the group structure. Because if that you want to know the group structure, you based on the number of shares that an organization has acquired from another organization, so that it will help you to make you know the group structure. If that organization is having more shares, then I hope yesterday we discussed what makes somebody to have control. So the moment you get the percentage shares, percentage of the ownership, therefore you should know that that company is what? A parent or a subsidiary. So if that you want to know whether Bernard it will be what? A parent. Therefore, we should go by dividing Bernard shares, which is 4 million shares. 4 million shares by 5 million shares of Benjamin. Then we multiply it by 100%. So based on this one will give us the number of shares that Bernard will be having in what? Benjamin organization. So anytime you are doing accounting and other aspect, make sure that you have your calculator with you. Just punch it. You punch your 4 million over 5 million, you multiply it by 100, you get your 80% shares. So it means that Bernard is having 80% shares in Benjamin organization. So this means that Benjamin is having 20%. So based on this ownership that Bernard is having in Benjamin's organization, everything shows clear that Bernard will be a parent, then Benjamin will be a subsidiary. So when it comes to this one, what we do is that you need to come and based on this analysis and use it to draw your what? Your group structure. So Bernard. Then you come and write also Benjamin. So Bernard is having 80%. Benjamin is having 20%. So it means that the NCI is what? 20%. This one shows that Bernard is what? The parent, and Benjamin is what? A subsidiary. So with this, when you do this one, you are not done. The other thing that you have to do is that you need to bring in the date of acquisition. Anytime you are doing a group structure, bring date of acquisition, date of reporting, and also you get your what? Post-acquisition period. So based on this question that I read, they said that on 31st December 20x8, that's when Benjamin what? Bernard purchased what? 4 million shares out of what? 5 million shares of Benjamin. So you come and write, so on 31st December 20x8 will be the date of acquisition. Date of acquisition. So we bring your date of acquisition. So date of acquisition will be on 31st December 20x8. Then, when you are doing, before you get to know your date of reporting, that's the date you are doing what? You are recording or you are reporting. So you go to maybe they will tell you that prepare a consolidated financial statement for the year ended or for this. So that's where you're going to get your what? Your date of reporting. So in this question, it seems the date of reporting was not specifically stated here. But you can see that, let's say, assuming the date that you are reporting will be on, let's say, 30th June 20x9. So if that is the date of reporting, so date of reporting is, let's say, 30th June 20x9. So you can see clearly from this side that when you check from 31st December, this month has already ended. So you count from what? You have to start and count from January, February, March, April, May, and June. Because this one is ending on what? 30th June. So it will give you post-acquisition period of what? 6 months. It will give you post-acquisition period. So post-acquisition period. That one is giving you what? 6 months. So this is how a group structure is supposed to be done. When you are done, the reason why I didn't write anything here, it comes with a meaning. It can be like maybe Bernard can also acquire another asset or another shares in another company, which that will make him not have control over that organization, but he will be having, let's say, significant influence. And as we say, that the significant influence comes whereby, let's say, somebody acquires shares in another organization, which is not up to, let's say, 50%, but the shares is also above 20%. So let's say that Bernard acquired another shares in a different organization, something like 30%. Therefore, Bernard will be having what? Some significant influence in different companies. So assuming that Bernard has acquired what? 30% shares in Prince Limited. So let's say Prince Limited. Bernard is having another shares of what? 30% in Prince Limited. So in Prince Limited, which is what? 30%. So because of it that Bernard is not having more than 50% shares here, it shows clearly that Bernard cannot say, I'm going to consolidate Prince Limited. So Prince Limited will be what? An associate to Bernard Limited. So what that will come here and do is that you just come and draw another line here, which shows what? An associate what? Line. So Prince Limited. Then the percentage is what? 30%. Then you bring it. This one too, you need to bring date of acquisition. So you bring your date of acquisition. You bring your date of reporting. Then you bring post-acquisition period. The same thing like how that we did when we were doing for Benjamin, or when we were checking on Bernard and Benjamin, the date and the rest. The same thing will come here, because sometimes the date might be different. You get it? So you need to also take very good note about this. So in some cases too, maybe when you are reading the first paragraph of the question, the examiner might tell you straight that maybe company A is having 80% or 60% in company B. That one, it is straighter. You can just come here and draw your what? Your group structure. So this is how that the group structure is supposed to be done. So far as that here, Bernard is having just 30% shares in Prince Limited. That one does not guarantee Bernard to have control over Prince Limited. So because of that, we are going to account for it using equity accounting or equity method. So we are going to use equity accounting, and that one comes with IAS 28. IAS 28, that's investment in associate. IAS 28. So let's delve into how that we can also treat when it comes to investment in associate, like how that I just demonstrated at this side. So let's come here and see how that we can get to know some of the stuff when it comes to IAS 28, investment in associate.